Hey everyone, in this video today titled Stock Market for Beginners, this is for all those people out there who want to learn more but are right just at the beginning, trying to understand, getting some information, whether you know a lot or a little. Hopefully today brings some value for you. And with that, we'll get into it. Straight into the first question, what is the stock market? In my definition, the stock market is an online meeting place where people can buy and sell tiny pieces of businesses. And these people connect all over the world through the internet to places called exchanges. And there are people that want to buy and sell pieces of the same company. So for example, if you thought Google was a great company, you would create an account and log on to one of these exchanges and you would say, I want to buy this. And there's someone else in the world who's connecting to that same hub and says they want to sell it. They no longer want Google, and you're buying a tiny fraction of Google, buying one of their shares. That's what a share is a tiny fraction or a tiny share of a company. Many different countries have their own exchanges, or that's where companies that operate in those countries are listed. So for example, again, using Google, that company is going to be listed on US stock exchanges. And some of the biggest are going to be the New York Stock Exchange or the NASDAQ. Those are just different exchanges, meeting places where companies can be listed. So that way people can kind of gather and buy and sell pieces of them. There are also exchanges all over the world. For example, Tokyo Stock Exchange, Shanghai Stock Exchange, and the Hong Kong Stock Exchange. All of these are all over the world. There's many others in Europe, in Australia, and really anywhere you look, in India as well. And just to throw in a little bit of information that I thought was valuable, the US stock market is currently worth over $46 trillion, which is kind of crazy. Now, for a company to be listed on a stock exchange, I thought it might be valuable to share how that actually happens and why a company would want to be on these exchanges where people can buy tiny pieces of them, buy them, trade them, all this kind of things. To get on the stock exchange, companies actually have to go through an initial public offering. You might hear it referred to as an IPO. Those are companies that are getting listed for the very first time. They're making their initial public offering. And to do this, they have to file a whole bunch of documentation with the SEC, basically to show that they are a legit company running according to the laws and they're meeting all the standards the SEC sets. So that way people that are buying them have at least some information to say, hey, this is a credible company, and they can review credible information to say, okay, I know they're making money, or I know they're losing money, or whatever it is they sell. You can get more information because you know they've gone through that process. Now, why would a company actually want to IPO? And in my opinion, there are two main reasons. The first is so that way the company can actually raise a whole bunch of money. So if we look at a company, let's say they're a company that's growing and they're doing well, but they need more money to expand, but they don't want to go out and take on more debt. And they think that people would be interested in owning them because they think they're going to grow. So they go out and they go through this IPO process, and they're going to sell 50% of their company to a whole bunch of people all across the world. And they do this to be able to raise that money without having to take on debt. And this is a great way to do it, to get a lot of capital just from the general public through their initial public offering. The second reason is it actually allows owners of the company to sell their pieces of the business much easier. Before, they would have had to go and find someone that was willing to invest millions of dollars to buy them out. But now, if they're a public company, they can just go onto the stock market and sell parts of their business if they're already listed there. And there's almost always going to be people ready to go and buy those pieces up. So in my opinion, those are the two main reasons why a company would want to be listed. Another important saying that I wanted to touch on that you probably have heard people generalize and say a lot: the stock market was up today, or the stock market was down today. Well, what does that actually mean? What are they looking at? What is up or down? There are thousands of companies listed on the stock market. So what does this actually mean? Generally, when someone is talking about the stock market being up or down, they're talking about something in the US called the Standard & Poor's 500, or the S&P 500. The S&P 500, in simple terms, is a basket of the 500 largest companies in the US. And they're all weighted by how big they are, meaning the biggest companies take up a bigger part of that basket while the smaller companies are really small. And this index, because it tracks all those 500 companies, generally gives you a really good idea of the general direction of the market, whether it's up, whether it's down, and kind of where it's trending. So that's what people are referring to when they say the stock market was up or down. This is the most common thing they're looking at. Now, why does anyone actually put their money in stocks? Why would someone want to do that? And the most simple reason is just to make money. On average, over the past 100 years, the S&P 500 index itself was up about 10% each year on average, meaning if you invested $100, that next year on average, you would have $110. There was a lot of ups and downs and swings to that, so that is not what you should expect every year. That is the average, and you can think within that average, there are years where it was up 40%. There are years where it was down 40%. So gives you a really wide range, but overall, if you average it, it was up about 10% over the last 100 years. I do think it's important to take into account inflation though, because we say the market is up 10% that year, but let's say you invested $100 because you wanted to buy something that cost $100. Well, that year, let's assume inflation was up 5%. And at the end of the year, the thing that you wanted to buy is now it costs $105. Well, if the stock market was only up 4%, so you had $104, you actually lost $1 because now you can buy less with that money. So it's important to take account inflation in determining how much is a stock market actually up on average when you take into account inflation, because that's where you really make money. If you're just keeping up with inflation, then your dollars can only buy the same amount as before, and you're not really making. So the S&P 500, when you take into account inflation, on average, is up about 6.5%, which is definitely quite a bit less than the 10% before, but still up significantly if you think about long-term compounding effects and allowing your money to grow. Now, I have two important concepts that I want to touch on today in this video as well. One is speculating and the other is investing, and the difference between the two, as I think they're really important to understand before you actually go out and start thinking about companies you want to invest in, no matter what your strategy is. There's a very famous book that's titled The Intelligent Investor by Benjamin Graham, and I think he sums this up very well. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. In other words, you need to do your research into a company so well that you feel very confident that it has the ability not only to grow your money, but it doesn't have really big risk of going down a lot. You want to do your analysis and your work looking into a company by looking at their actual numbers, understanding their management, and understanding their industry that they operate in. So for example, let's say you know a lot about the medical field and how hospitals and insurance operates. You might have a really good edge or knowledge in looking into different health insurance companies. You might understand a little bit how they operate, how they make money, and if they're really good or not, if they have great customer service, and if they're good at retaining their customers and clients. If you're able to do that and you do your work into a company and decide they have a great future, they are not going anywhere anytime soon, and even if bad things happen, you know that their customers love them. They're not going anywhere. If you can understand that, and this is important as well, see that what the market is currently saying they're worth is less than what you think they are, then they could be a good buy. If you know a lot about a company, that doesn't mean you to go out and buy them right away. Price is important. Just like, for example, if you were in need of a new car and you saw one that was great, it ticked every box on your checklist, everything you needed, but it was $150,000 more than you thought you should pay for it, you're not going to get it, even though it checks all the boxes. Exactly the same thing in investing. You want something that checks all the boxes and is in a good price point. You don't want to overpay for companies because that means you're going to be exposing yourself to risk. Now, if you look into a company and you don't understand maybe the industry that they're in, you're looking at a company like NVIDIA that makes computer chips. It's a very complicated and complex industry that is evolving really quickly. It's, in my opinion, very hard to understand and see the future of what that's going to look like. It looks bright, but you have no idea who the big players are going to be or who's going to win, if you want to look at it that way. If you don't understand an industry like that, then by Benjamin Graham's definition that I read earlier, that is speculating, which is really just a form of hoping someone in the future will pay more than you do right now. You don't know if they have a good future. You don't know the management, you don't know the industry, and it really just comes down to hoping. And that's what you want to avoid at all costs. This is a principle that's called staying within your circle of competence. One of the last concepts that I thought would be really valuable to talk about here today is something called the weighing machine versus the voting machine. It applies to two different time frames when you're looking at the stock market. If you've ever looked at it before, you'll probably notice that stocks are up or down every day. Even though from day to day, nothing might have changed. It might be the exact same as it was yesterday, but to the investors, they may be buying more, which pushes up the price, or selling more, which pushes down the price, just kind of according to opinion. And this is where the voting machine comes in. Every day, they're just voting up or down based on the latest headline, the latest news, even if that latest news or headline doesn't actually mean anything for the long-term future of these companies. I just want you to understand that day to day, things are pretty random. They are up or down just based on whatever is hot that day. Now, in the long term, we get into something called the weighing machine. So really, if you look at a long-term example of companies, you're going to see that they follow the best how much money they're making. So as a stock price goes up over years, we're not talking about days, weeks, or months. I'm talking about years and decades. It's most closely going to follow how much money they're actually making. That's what you really want to focus on is long-term companies, how they're going to do over the next 2 years, 3 years, 4 years, decades out. And understanding that in the short term, they might be up, they might be down, but in the long run, if you have a good picture, you know that the weighing machine is going to beat the voting machine. Another thing as well, that voting machine actually works for your benefit. It means for no reason at all, or for no justified reason, the stock market might fall a lot. And you might say, I can see this company that I know has a fantastic future, but people are saying it's basically worth nothing. And it allows you to buy something for pennies on the dollar. This might be a really weird concept to think about, but in the stock market, it is the only place where things go on sale by 50%, 70%, and people run out the doors. They don't want anything. But that's what happens in the stock market. It's an opportunity for you to go and buy companies for pennies on the dollar if you understand their future. Just because a company's down does not mean it's worth anything, and it might be in a permanent fall. Examples might be a newspaper company. Just because it's down a whole bunch doesn't mean it's a good buy. Newspapers are going away. Do your work and understand things, but if you do, then these big swings can be in your favor. You can buy things for pennies on the dollar, and when people decide it's the best company in the world, then you can sell it for $10 on the dollar and make a whole lot more. That's an extreme example, but it illustrates what you can actually do when you understand the voting machine versus the weighing machine. Now, I want to tell you as well the time frame that I'm actually thinking in here because it's important. And it's important to have a lot of patience when you're investing. My time horizon is years, if not decades, for a lot of companies that I'm looking at. Obviously, I'm hoping for things to go well in the short term, and I'll take advantage of that. But if it takes decades, I feel like I understand the companies that I invest in well enough to feel confident in their management, in their future, in their products, that they'll do well. So with that, hopefully this was valuable for you guys today. And there might be little pieces here and there that you have questions on. Don't hesitate to throw them in the comments, and I'd be happy to help in any way I can. Thank you guys, and we'll see you in the next one.